Hey, what is going on, my friends? It looks like I am live. Let me know if you guys are able to see and hear me. It looks like I can see what you guys are putting out there through the comments. Let me know if you guys can hear me through the mic. There's a little bit of a delay. Also, it's been brought to my attention that I don't see all of the comments. So I use some third-party software to go through a YouTube live stream. I use this third-party software so I can put up comments on the screen, kind of like this. And I guess that software is not putting through all of the comments. So some people are complaining that I'm not answering your questions. Um, if I see them, I'm answering them, guys. Although I will say one thing: if you use the super chat features, it does definitely help me see your questions. And just because it causes me to it basically catches my attention. So Shoeless Joe, in terms of SoFi reporting its quarterly earnings for Q4 of 2021, that looks like that is going to go ahead on, let me see here, March 1st. The call was scheduled some time ago. You can always see that through SoFi's website there. They're doing that on March 1st. There's a dial-in number. I don't know. As far as I know, I think you're overseas. I don't know if they have an international dial-in, but there's also a webcast, which is audio only, that you should be able to get on. So I'm actually pretty excited about that. SoFi's bank charter was finally approved. I saw an interview with Anthony Noto where he described crying when the bank charter was approved. Good for him. I'm not sure I would cry over something like that, but good for him. But he was explaining to, I had a recent experience with one of these things with one of my own businesses where we acquired another business, and I didn't quite understand how many other avenues this was going to open up in terms of how many different ways we could earn income. And I think that's kind of one of the things that's going on with SoFi right now with the bank. They have 50, 100 different new avenues in which to earn income from. And I think that's only going to benefit for the stock in the long run. So, guys, in particular, I want to warn you that despite the fact that things have been really good over the last couple of weeks, that we're not done with market volatility. We have people in the financial industry, professionals in the financial industry, who have been in it for 10 years now, 12 years now. They've never experienced a normalized interest rate environment where people are still making money as interest rates rise. People are still making money as inflation rises. They've never experienced that. And there's going to be, I think there's going to be a bit of an overreaction no matter what happens on March 16th. I've said it before on this live stream. I'll say it again. I fully expect there to be a rise in interest rates. But look, let's talk about interest rates outside of the United States right now just for a second. And we're going to talk about why this is not so bad here. So Goldman strategists see the end of European stock woes in the European Central Bank pivot. All right. So I think that's pretty important to take a look at that. And they've gotten hawkish, or a little bit more hawkish on interest rates lately. And Goldman's is saying that investors should stop worrying about and start loving the European Central Bank's hawkish pivot, according to Goldman Sachs Group strategist. And this is why. The dramatic shift in rates, especially in Europe, is a sign that the problems that plagued Europe in the last cycle, which was low nominal GDP growth, disinflation, no earnings, are finally diminishing. Strategists including Sharon Bell and Peter Oppenheimer wrote in a note on Thursday. So some of the biggest reasons for Europe's longer-term underperformance have started to turn, is what they're saying. And that's indicative by the European Central Bank's more hawkish turn on interest rates. Now, let's remember, the European Central Bank's mission is a little bit different than the Federal Reserve's mission. They only have one mission, and that is to control inflation. That is it. The United States has a goal, at least the Federal Reserve here has a dual goal of controlling inflation and full employment. And full employment is the one that's interpreted rather widely, and they have a much wider mandate than the European Central Bank does. So, yeah, last week's abrupt change of tone by the ECB President Christine Lagarde caught investors off guard, triggering a sell-off in European bonds and exacerbating declines for equities that were prompted by fears of Federal Reserve tightening. Fund managers and strategists are split on whether the rally that catapulted stocks to successive records can continue as major central banks turn off liquidity taps. This is one of the reasons why we're probably seeing a lot of big money managers being a lot more interested in increasing the allocations that they have to international markets at this time. We've seen tons of folks. We've seen tons of money move out of Europe as it's underperformed really since 2008. We've seen underperformance in Europe. Now may be a time to re-examine your allocation if you're not specifically allocated to Europe. That is something I'm actually definitely reconsidering. Okay. Yeah. So let's get to a couple comments. They're starting to come in right now. And let's see. Pat Mulligan says, do you know anything about the shenanigans in Elms? Actually, no, Pat. I have not taken a look at that yet. I'll see if I get to that sometime soon. So Nikhil Diva says, hey, man, when do you think XPEV will go to 100 by next year or by 2025? I'll be honest with you that I think to 100 is probably not likely by this year, by the end of this year. By the end of next year, I think that going to 100 by 2025 is extremely likely. And I think that Xpeng is pretty far ahead in terms of their plans to increase production. So look, there's been some interesting takes on Tesla's last earnings report and their last quarterly meeting, where they basically said that they're not coming out with new vehicles this year. They're going to concentrate on increasing production. And the investors are kind of split on that. Some people were very excited about new models. I'm very excited about new models, let's be honest. But I think more important, when you look at Tesla, how they market their vehicles, they don't actually spend any money on marketing. They rely on Tesla users and green gadget geeks like myself and tech nerds like myself to go out and buy the vehicles and spread the word almost like a new religion, right? And the best way to do that is to get those vehicles in as many hands as possible. That is their best marketing strategy. And that's also their best strategy to test out their vehicles as well. They don't really have a quality control department anymore. They essentially use early adopters as quality control, which I think is a pretty bad business strategy. But hey, what do I know? I'm not running Tesla. But I think that the plan for Tesla to concentrate on increasing production is the right move to do. You want to get distribution as wide as possible at this point, at this inflection point where we're starting to see competition. I see daily now on my commutes wherever I'm going, Mach-E's, which I didn't think that was going to happen. I didn't think it was that big of a seller, and maybe it's just a big seller in the region where I am. But I'm also seeing electric vehicles now that I don't even recognize, and I look at these things all the time, and I realize that San Diego is a test market for many vehicle manufacturers. Like I see vehicle models that are intended for sale in Indonesia being tested here in the U.S. kind of on a regular basis by Toyota and a couple of other companies. I see the test vehicles intended for markets in Western Australia, in Portugal and Spain, all kinds of things. They're being tested here in where I live in Southern California. So maybe that's part of the deal here. But what I am seeing now, like I said, is actual Mach-E's on the road and things like that. So I'm very, very excited about that. But it does lead me to believe that the increase in production, raising the visibility of Teslas on the road, is probably a better way to go with the existing models that they have than trying to have this full panoply of models that's out there, right? I think it could be a very smart strategy, which is to concentrate production of their lowest cost vehicle right now to get the brand out there as widely as possible. I do think they're missing an opportunity, though, when it comes to the Cybertruck. I think there could be far greater demand for the Cybertruck than people think there is. And I think that they're really seeding that market space. Well, they're not seeding the market space. That market space for the full-size truck is owned by Ford. It's been owned by Ford for 50 years. They were going to have to take that away from Ford if they wanted to do that. Ford's going to beat them in the market with the Ford Lightning. What their production capacity looks like, we don't know yet. But Ford knows how to manufacture a vehicle. I can't say that the reviews of the Ford Lightning have been really, really good. And I think that Tesla could be making a mistake in the long run by doing that. Seeing the Tesla Semi is something that I really wanted to see as well. So, all right, here, just a second. Let me scroll back here. And so what are your thoughts on Palantir? So, guys, I've covered Palantir numerous times on live streams, a couple of times on my channel. And I got to be honest with you, like I don't see Palantir as being extra special like a lot of other companies, like a lot of other YouTubers do. It's certainly an interesting business. It probably could be very, very good for a long-term investment. But do I expect 10x in the next couple? No, I don't. I expect it to earn what most military contractors earn, which is somewhere between 10 and 12, or military and government contractors earn, which is somewhere between 10 and 12% over time. And that would be a great return for a stock like that, meaning it would double pretty much every 7 years or so. That would be a fantastic return in terms of traditional investing. Do I see it as someone on the bleeding edge of technology? Sure. But there's a lot of people on the bleeding edge of that technology right now. There was this really small company that went public early in January, and they do everything that Palantir does. When they went public, though, they were not a company that had been around for 20 years without profits. They've been around for 20 years. They have far less in the way of revenue, but they're a solidly profitable company. And they use their SPAC proceeds, of course, to expand operations and to really sort of basically, they're using their SPAC proceeds to expand into the civilian sector. They've done only government work for a number of years. What is that spot? And now they're expanding. And that company's Big Bear AI Holdings. So I've been looking into them. I'm not recommending anyone, of course, to buy or sell anything via YouTube or live stream. You should look these things up for yourself. But they're not the only ones that are out there competing. Look, Splunk is doing their own thing. C3.ai. You're looking at Snowflake, and look, so one of the things, I can't remember the name of the protocol right now. I was just reading about this the other day, but there's a whole graph database protocol, which is a new way of arranging databases. If you were never like a tech geek like me, you may not know the history of flat file databases. Then relational databases came around with Oracle. I mean, they didn't invent them, but they were the first company to really specialize in relational databases back in 1991 or 1992. It may have been earlier than that. I don't remember. But that was a big deal. It was a huge shift in thinking. And a lot of people couldn't wrap their way around the way data was organized like that. And now you have this graphical way of mapping databases, which is a new concept and a new way of organizing things. I've talked to a number of people now in database management, and some of them have never heard of it or never working with it. But this is one of the things that we're using AI to do, which is to have a graphically served database. Palantir isn't the only company doing that. There are hundreds of companies that are out there. They're not even the largest company that is doing that. They're not even the company that has the most in the way of government contracts that is doing that. But this enterprise scale database development and connect and visualization and using the data that you have to make predictions, not simply to respond to things that are happening, but to make predictions. That's kind of the new wave when it comes to data analytics. And it's kind of hard to explain this through a YouTube live stream without, a whiteboard and some markers to erase and all that stuff. But there's a whole host of actual technical reasons why I don't think that Palantir is really extra special. And I think that you're going to look at 10 years from now, you're going to look at their growth and you're going to see something that looks a lot like SAIC. SAIC is a Science Applied International Corporation. They went public, I think, back in 2006 or 2007, and they've done really well over the last 15 years or so, but it's been a steady 10% growth year after year. That's kind of what I expect from Palantir over time. So I mean, basically doubling. I think they'll have an initial run up where they do pretty well, up to $40 or $50 a share, and then after that, we probably see that 7 to 12% growth, in that range over time. So, yeah. So that's my opinion on them as far as a stock goes. Most of my opinion is based on my experience with other types of software now. And it's been 2 years since almost 2 years since I've been looking into them. And I've had some experience with a lot of their competitors now. And I can say that they are definitely not special. It's Alex and Peter are what make that company special. And it's a lot of it has to do with their personalities and mystique. And, but they're not doing anything that a number of these really, really large companies that service the government are doing. So, yeah. Let me see here. Nate says, healthcare stocks up today, BNGO, PVM, and CRISPR up today. They were big. And I think a lot of them, well, CRISPR would be hard to call a healthcare stock. Definitely a biotech stock, but not necessarily, and BNGO as well is not really a healthcare stock. PAV, I'm not sure. But I think some of those, they're not necessarily unfairly beat up because genomics is an industry that is completely in its infancy at this point. CRISPR is a little bit unjustifiably beat up right now. They actually have revenues. I know they're not profitable, but genomics is something that I think is going to revolutionize the way we do medicine, in particular the way cancer is being handled. There are a lot of like individually specific cancers that occur out there that can be treated with gene therapies, and I think that is going to be something that comes as a much faster than you and I can anticipate. It's going to come relatively soon, within the next 5 to 6 years. And I'm gonna need to point you guys. I wish there was a way I could like dynamically share links with you guys. I heard this great like TED talk. It wasn't a TED talk. It was something else. It was like an hour long by one of the leading genomics researchers. This is on the board of like 5 or 6 of these different companies, and he talks about how stunned he is at the progress and the speed at which they progress, where things that he thought were going to take 50, 60 years to do, they've achieved in 6 years or less. So yeah. Jason, do you think that PayPal and Meta have bottomed? Thanks. So I just want to let you know, guys, the super chat features are on if you are so inclined. Let's talk about PayPal and Meta. So I don't think that Meta has bottomed at this point, and we're talking about Facebook, right? Not the ETF for the metaverse. We're talking about Meta platforms or Facebook. So now might be a good time to buy into Facebook. I don't know. I do think that for the next year or longer, they're going to be making a huge investment and pivoting to the metaverse. And their pivot to the metaverse may not actually pay off. They may not end up being a player in the metaverse. All right. So somebody who made a comment on my channel 2 or 3 days ago made a very interesting point on the video that I made on metaverse. They're like, look, if you had looked at AOL, America Online in 1996 and said, well, 10 years from now, this company is going to be in the trash, no one would have believed you because of the giant lead they had in their subscription base. But it wasn't even 10 years. And basically AOL was relegated to the garbage heap of history, right? And there have been all kinds of jokes and memes made about the volume of CDs, the free AOL CDs that they sent out. But I think that this pivot to the metaverse may be something that does not pay off for Facebook. The change in the way that that Apple is sharing data with Facebook, and now it looks like Google is sharing data with Facebook, may have a giant impact on advertising revenues. And it may be that Meta has peaked. It may be that their pivot to maybe the metaverse does fine. It's just that Facebook is not leading it. If you think about the AOL analogy, AOL didn't do well, but the internet did just fine. In fact, almost every idea from that period didn't do really well on the internet, but the internet itself did fine. It found ways to succeed. So no, I don't think that necessarily that if you, I haven't even paid attention to Facebook stock since I made that video. But if Facebook stock has gone up a bit and you feel like you missed the bottom, just hang on. I think it's going to, be even a better entry point later on in the year. Next time they report quarterly earnings, I don't expect to see much improvement. And I think there's going to be a lot of expenditures for them as they're pivoting to the metaverse. I think they've been planning this metaverse pivot since they bought Oculus Rift or Oculus. In terms of PayPal, in terms of PayPal and Square, I'm a little bit more concerned now, especially now that Stripe and Apple seem to be cooperating, where you're going to have basically, you're going to be able to use your phone along with Stripe to process, and anyone can process payments. That's a huge problem for both Square and PayPal. They're both going to have to pivot, and this is one of the reasons. So I'm slowly buying Square shares, probably like 1 a week at this point. I think I bought 4 in the last week. And not at any particular price, just when money comes in, I'm buying a share of Square here and a share of Square there. I don't actually expect to make money for quite some time on these shares, just because like Facebook or Meta, I see that Square is going through a period of reinvestment. Now they're pivoting towards the blockchain. That is another technology that may or may not pay off. When I say pay off, it may not pay off in the way that people think. Blockchain's here to stay, guys. Any particular cryptocurrency may not end up being successful. and people may figure out that how often a network is used may not say very much about the tokenomics of that particular like token that's used on that network, meaning it may not do anything to push up the price, but the use of blockchain is just going to increase from here on out, and it's going to be used not just for transactions, but in a lot of different ways that we haven't even thought of. And I think that gaming is going to be one of the big ways that the blockchain that is going to be used, and I think it's going to be really exciting to see. But I think it's going to be highly unpredictable. So Square's pivot to blockchain, I hope, is not just from the transactional front. I hope there's a lot more going on with that. So PayPal also is going to have to make that pivot. They are more threatened in a way by the teaming up of Stripe and Apple. That's a big deal, folks. Stripe's IPO, when it happens, is probably going to be the largest IPO in history. I think they're valued somewhere north of $90 billion at this point. And I think that they're shooting for a $2 to $3 billion IPO. And so I think it's pretty amazing. Brian Lee says, hi, Brian Lee. What's up? Let me see here. Nate Robinson says quantum scape or QSI. I'm sorry. I thought you said quantum scape. So, and here, so we're looking at quantum incorporated here. I actually just don't know enough about QSI to make sort of an educated guess here over a live stream. Okay. So they operate first generation protein sequencing and a genomics platform for healthcare industries. It offers simple molecule detection solution to decode molecules. Okay. Yeah. Including simple. All right. So, I actually don't know enough about them in particular to make an educated, to give you any sort of like educated guess here. They are one of thousands of, or not thousands, but at least hundreds of companies that are being traded in this space right now that are around the same price range, where I think that the general public and even industry analysts in general are not going to understand enough about the technology in particular that's being used to understand whether or not it's actually going to be useful in the future, or if it's going to be surpassed by someone else. This is one of the reasons why I invest pretty broadly in the genomic space, and I just use the ARCG ETF to do that. I'm very tempted to take individual positions in companies, but so far I've resisted that temptation, even though I want to swoop in and buy some Nvidia shares, and I want to swoop in and buy some CRISPR shares and some Pacific Biosciences. So Pacific Biosciences is doing a lot of work in DNA data storage. And I don't know how to express this to someone who doesn't really have a decent depth of knowledge when it comes to how data is stored on a hard drive. But let's just say that using DNA storage to do that, number one, DNA is really stable, and it can be read for hundreds of thousands, if not millions of years after an organism passes away. But not only that, we can store it in an artificial format now. It's something where we understand the dynamics of it. We understand the pairings of it, if not all the different relations. But we can actually write our own data into DNA sequences right now, put them into living organisms, and read it back out with like 90% efficiency. And that's with a technology that's really, really immature, and no one's really even thinking about commercializing right now. So I think that this is something that's going to be explored in the future. And Pacific Biosciences is the one company that's really sort of leading the charge on this, and it's not getting any press whatsoever. I think it's not really well understood, but I do think because of its. So we're running out of hard drive space on the planet. I don't think people realize this. We've got basically something like another 100 years of hard drive space left, and then we'll have more information stored than the world can handle on all if you just produce hard drives every day, all day. So we're going to have to find a new way to compress and store data at some point. And DNA data storage looks like a pretty good way to go. Only time is going to tell on that. So Moonboy says, do you think CPI will be higher tomorrow for January? And what is the probability of a recession? I think that the probability of a recession. So let's talk about how we define a recession. A recession is going to be defined as 3 consecutive quarters of the economy shrinking, right? Which means that we have not had a recession since 2008. We did not have 3 consecutive quarters of shrinking GDP growth or shrinking GDP even in 2020, right? So that's the academic definition of a recession. I think that the chances of recession are actually a little bit lower than most people think. If you guys saw my videos in the last couple of weeks, I've been saying that, hey, most people are wrong about the economy. The economy is in pretty good shape. We're dealing with inflation due to a number of factors that nobody really understands completely. Even economists don't really understand this completely. They argue about this all the time, but a lot of it has to do with wage inflation. Wage inflation has to do with the fact that there's about 1 million fewer people left in the workforce. A lot of those are people who decided to work early. A lot of those are or people who've gotten jobs in other industries, but there's 11 million open jobs out there and not enough people to fill them. And it's not because people don't want to work. It's because they don't want to work for the wages that you're offering, right? So that's happening in a lot of cases right now, and that's pushing up labor prices. Labor prices are in some cases are being pushed down the line. But you can look at some other things that are going on in the economy too. Like I have a number of different companies, and my labor expenses have gone up, and I'm not having to push. It's not increasing the prices of the end product by that much. It really isn't, and it's so look, the CPI. I expect that the rate of acceleration of CPI to be slower, meaning I still think it's going to be higher than it was last year. It's significantly higher, but all indications is that the rate of inflation basically already peaked, and it's still increasing, but the rate of acceleration has already peaked, and that started to decline. And that started to decline really back in December. So we should see sometime in this first half of the year that inflation starts to peak, but it's going to be higher than it was in the last couple of years. Target inflation. The Fed wants inflation to be somewhere between 2 and 3%. That's what they want to go back to at some point. So there are already tons of pressures on money supply right now, where a lot of it has been sucked out. The child tax credit sucked hundreds of billions of dollars out. Tapering is sucking about $120 billion out of the economy each month. So there's a lot going on right now that is sucking money out of the economy that is going to help interest rates rise, although we did see a significant fall in yields today. So I noticed that there's a lot of confusion as to how interest rates work on debt and how the government pays interest rates. So when the government sells a bond, they sell a bond for $1,000. It has a coupon rate of 5%. So they owe on $1,000 bond, they owe $50 of interest per year. So if interest rates drop to 2.5%, the government still owes $50 of interest on that $1,000, right? The difference is that the price rose. You're paying a premium to buy that bond because now interest rates are right at about 2%, but the coupon rate really doesn't change. These instruments go for sale at auction, and the coupon rates really don't change that much, and they really haven't changed now for like 25 years. They've been really, really close to the same. So the just because interest rates go up doesn't mean that on most of the debt that's issued is fixed debt. I actually looked this up not too long ago, but if interest rates go up by 0.5%, that basically means that I think it was about $500 billion per year in extra spending that the government's going to do for each 0.5%. But that's really only on TIPS, which is the Treasury inflation protected securities. Everything else is fixed coupon, and new issues are not going to be issued at different coupons. Those are going to be sold at auction, and they're going to be sold at a discount, which means that the person who buys it is getting better yield, but the government's still paying that 5% coupon on that debt. So I noticed from comments that there's tons of confusion. Just because interest rates go up by 1% and we have $29 trillion in debt, it doesn't mean that that the government is now paying 1% more on $29 trillion of debt. Those interest rates are fixed. Even on new issues, those coupon rates aren't going to change because they sell at an auction. It's the price that you pay for the bond that's going to affect your yield to maturity. And if you don't understand the difference between coupon yield to maturity, and those things, you should probably take a look at how bonds work and to get a better understanding of how we fund the government using debt. And that the whole point of taking out debt, the whole point of selling someone a 30-year bond is so we can pay you interest right now that doesn't keep up with inflation, and we can pay you later on down the road with inflated dollars, meaning that you are betting on a decrease in purchasing power with what you use to buy bonds with in exchange for security, right? So you know that you probably won't keep up with inflation if you own bonds in exchange for security, that you will get your principal back. It may just be in inflated dollars. That's the whole game of a fixed income portfolio and a whole fixed income trader, and that's the whole game of how governments fund the future is they plan on inflation. This is a subject for some reason that enrages people, and they get very emotional about it, and they refuse to understand it. They just want to get angry about debt. We do need to do something about debt. I think that we should be issuing less new debt and letting old debt roll off the books. And to do that, we have to cut spending in one way or another, and or raise taxes. And neither of those options are actually very popular. So no political party has really been willing to cut spending in the last 35 years or so. But raising taxes and lowering taxes, no one really wants to raise taxes either. So, but yeah, do I expect CPI to be higher because producers have been eating price increases to a starting point? We'll start passing them over to the consumers going forward. Honestly, shipping expenses and labor are probably the biggest contributors to what's going to cause a rise on the CPI. And I don't know that for a fact, but that the data that I'm looking at is showing that because we're such an interconnected and global economy, the data that I'm looking at is showing that that's probably the biggest contributor, which means that it's going to be passed on to a degree to the consumer. But once supply chains normalize competition, because we do live in a capitalist society, competition is going to force prices go back down again. Eric M says, "Do you think that Cathie will hit 40% a year?" You mean Cathie Wood hitting 40% returns in a year? Look, those returns are dependent on how the market does. She's still part of the market. You can't fight the Fed either. If the Fed does raise interest, and I do expect them to raise interest rates on March 16th, I even think that they may raise interest rates a full half point on March 16th, which would cause a bit of a shock to the stock market. By the way, I'm having another guest on at 9:30 in the morning tomorrow with a live stream, and we're going to talk about some of the research that his company has done and how they think that March and April could be pretty rough. So I'm a pretty long-term thinker, so I don't really think that much about short-term volatility. It is something that I overlook because it just doesn't matter to me. If I'm down in the next 3 months, I'm really looking at 2, 5, 7, 10, 20 years out in the future. But he runs a money management firm. Like he actually manages hundreds of millions of dollars in investments. And they've done some research, and we'll talk about. I don't necessarily agree with this, but I do want to talk about this with him tomorrow on a live stream. You guys will be able to ask him questions as well. He's been on my channel before. His name is Amar Shah. He's a good buddy of mine. I've known him for about 10 years. But we have differing perspectives many times, and I respect his intelligence and his opinion. So back to the question. Will she hit 40% a year? I think that thinking about 40% a year is an unrealistic expectation. If you look at Cathie Wood's returns on her funds, she gets the returns on her funds because she takes a lot more risk. Not everyone understands that you're not just buying a more efficient fund when you purchased ARK Invest in 2014, and it was the best performing mutual fund, especially compared to the S&P 500 or the NASDAQ 100. She did that by concentrating risk, though, meaning that now that risk has come around and is turned around and kind of bitten her in the rear end, right? And her response to that has actually been what I expect out of a really, truly stellar money manager. There are some individual choices in terms of securities that I don't necessarily like, but her response has been to double down on what she believes are long-term trends in creative destruction of value in some of these larger like S&P 500, NASDAQ 100 companies because of the pace of rapid innovative change that we're going through. And I tend to agree with her on that. And if you think that is the case, you would definitely not change your strategy because of a single bad year, even a really bad year like she had last year. The fact that there were so many outflows last year, actually gives her. So one of the problems of the ETF structure is you can't close the fund, right? As money comes in, she has to create new shares. As money leaves, she has to destroy shares, right? You can't close the fund. It's not within the purview of ETFs, which that is sometimes that's the death of some really good funds is when they can't close the fund. So the fact that there were a lot of outflows last year probably kind of works in her favor. And so I'm going to say that this year she's probably still going to outperform the NASDAQ 100. I don't think she's not going to hit anywhere near 40%. And if she does, it would be a miracle. And I don't think you can expect that going forward. I think that you should expect outperformance of the NASDAQ 100, but sort of in proportion to the amount of risk that she's taking above the NASDAQ 100. Meaning having 10% of your portfolio in a single stock like Tesla certainly helped her outperform the NASDAQ 100. But I went back and took out the Tesla investment and just looked at how she still would have outperformed the NASDAQ 100 even without Tesla as an investment during many long periods from 2014 to 2020. She still would have outperformed the NASDAQ 100. So I do think she's a stellar manager. I do think she understands the future better than many money managers do. So just saw the live stream notification, clicked and cracked open a beer. Yesterday, I don't know if you guys noticed that I posted a picture of me I was actually sitting on the beach enjoying a beer. I ended up doing like a 5-6 mile walk on the boardwalk on Mission Beach in California. I shot some video of just people walking by this outdoor bar where I had a couple of adult beverages and a salad. A wild day out for me is 2 beers and a salad. So I'll not be drinking on today's live stream, but I'll be back to doing beer and asking questions next week. Let me see here. So Nate Robbins says ARK will hit 40 from time to time, I bet, but not every day. Of course, yeah. Epic Cancer says, how do you think Nvidia's quarter will be? I'm trying to finish my position. By finish your position, do you mean get to 100 shares so you can start selling options on it? That's kind of what I think of as finishing a position, is getting to a point to an even lot where you can actually sell options on it. I think Nvidia's quarter income wise, earnings wise, is going to look fine. I think that people are going to be disappointed by the fact that, of course, they've abandoned that ARM acquisition. There was significant opposition from all corners of the industry, though, for them for that acquisition. I don't know what they're going to do. I think they may take some of the money that they set aside to acquire ARM, and maybe they try and acquire a smaller player, a different technology, or maybe they try and develop their own manufacturing facilities. I don't really know. But the ARM deal is probably dead. It's 95% dead at this point. So Shoeless Joe sending me £3 sterling. Thank you so much, buddy. Thanks for reminding everyone that these super chat features are on. All right. So Nate Robbins says, I'm torn on Nvidia, tons of potential EV graphics metaverse patch, but I'm not torn on Nvidia at all. Not in the slightest. Basically, I think Nvidia is a lot like buying Amazon in 2005. At no point has Amazon ever looked like a good investment in terms of price to earnings ratio, in terms of especially not in profits until like the last 5 years or so. At no point from 2005 to 2018 did it look like a good investment or one that wasn't expensive. Nvidia is going to be the same way for a very, very, very long time, and especially as these newer technologies become more mature. So I think that, and I've said this before, I think that we're going to look back, and barring a couple of small caps that no one's heard about yet or no one knows about yet, I think that Nvidia is probably going to be the best performing large cap company here over this next decade, say 2022 to 2032. I do think it's going to be the best performing stock, or not the best performing large cap. So, yeah. So Eric M says, can the Fed raise interest rates without causing recession, considering total debt is many times over GDP? Well, the answer is yes. They've done this many, many times. And total debt is not well. Total debt is right at about 100 times, or is right at about 100% of GDP. It's not many times over GDP. But yeah, they can. And so remember, not all of that debt is payable at once. It's usually between 10 and 30 years in terms of debt. The interest rate on most of that has been exceptionally low. One of the things that people aren't talking about right now is revenues to the government are exceptionally high in terms of taxation. And the thing that no one is going to do, though, which is what we should do in order to control debt, which is cut spending. And there are a couple of obvious places to cut spending, but I can't really talk about that without getting into politics. And politics is something that I don't do. I do think that we're going to see fewer instances of interest rate raises in this year around election time. We probably won't see one in September just because the Fed doesn't want to be seen as interfering in politics. That's why I think they might front load a 0.5% in March. So Frantic Pillow says, "You're a legend, man." Normally I put the highs up there, but I don't really put the compliments up there because I'm kind of embarrassed by them. But you are a long time subscriber. Thank you so much, man. Looks like ARK-K roughly doubled between 2014 and 2019. Not stellar. Yeah, the problem is you're not looking at 2019 and 2020. And even if you're looking at the NASDAQ between 2014 and 2019, ARK still outperformed the NASDAQ in that time period. And that's roughly over that 7-year, or over like 2014, 15, 16, 17, 18, 19, 6-year period. If you're doubling, that's more than a 13% return, which with a diversified portfolio, even one that's concentrated in technology, that's more than you should expect. So you shouldn't you shouldn't expect a mutual fund to do better than that, is what I'm saying. So let me see here. I guess my question is, are you good at buying Nvidia at 250? So Nvidia is another company that little by little I've been acquiring shares. And I've been doing that now for a couple of years. And largely, and I think I'm up a total of like 453% on Nvidia at this point. And the question was always in my mind too, is this company is so large already. They're already the largest GPU manufacturer. And that's back when I thought they were only a GPU manufacturer and they didn't have much else going on. But I had the benefit of having two clients. They were a married couple who were engineers, and these were like financial advisory clients who were engineers at Nvidia. And I already owned some Nvidia stock, but they really sold me on the plans that the company had for the future. And Nvidia has only added to those plans since I had those initial conversations with those clients. Do I think Nvidia at 250 is a good buy? I think it may go lower today, especially in March and April. But I think that 5 years from now, you're not going to remember the anguish that you felt buying Nvidia at 250 or missing out at buying it at 210 in April or something like that. I don't think you're going to remember that regret, because 5 years from now, I think it's going to be worth 500, 700 bucks a share easily. So yeah. Let's see here. I was wondering if you saw TU Simple TSP. Oh man, I thought you were talking about the thrift savings plan. And let me see here. I don't know anything about Too Simple. Let me take a look at them real fast here. Too Simple Holdings. Just give me a minute for this to pull up. Looking at this on the easiest. Hold on a second here. So Too Simple Holdings is an autonomous technology company that develops autonomous technology specifically designed for semi-trucks in the United States and internationally. It intends to produce a line of purpose-built level 4 autonomous semi-trucks for the North American market. The company operates its autonomous freight network, L4 autonomous semi-trucks equipped with its autonomous driving technology. Its AFN is an ecosystem. Okay, so that's just getting credit. And it's founded in 2015. And it's based in San Diego, California. Really odd that I haven't heard about it since it's based where I live. So, all right, let's take a look. Let's take a look at this right now. Okay. I would be, let me see here. Let me share my screen. All right. So let's take a look at this here. So take a look at this. I don't know if you can see my cursor right here. Look at here. We're looking at financials, and I'm looking at annual financials here. The company was founded in 2015. They basically don't have a product at this point, and I can tell they don't have a product because of this. In 2018, they had $9,000 in revenue when they were founded in 2015, and they had $710,000 of revenue in 2019, and they had $1.84 million of revenue in 2020. This may be a legitimate company. I don't know that. They don't have a, yeah. So look here, the autonomous truck company, Too Simple, logs 550 driverless miles in Arizona. How many driverless miles has Tesla logged at this point? Probably millions. Even for their Cybertruck. How many autonomous miles or has Packard developed or done at this point? At least in the hundreds of thousands. Same thing for I just can't remember the name of the people making the Hypertruck ERX. I can't remember their name right now, but so I would keep an eye on them. Their losses are negative $5.11 per share. 1 year target estimate is 52.67. I don't know who's putting that out. This is a company that has no revenues. Average volume is about 2 million. The 52-week range has been between 14 and 79. I don't know what that $52.67 estimate would be based on. It can't be based on sales. The float here is large enough that I think that's a bit unrealistic. So I don't know who these analysts are who are covering this. Let me see here. China Renaissance Hold, RBC Capital, okay, Morgan Stanley to overweight, CICC to outperform, Credit Suisse outperform. So, okay, those are some heavyweight analysts in there. But I don't understand this price target at all, especially for a company that has no revenues and $160 million in $177 million in losses last year. So yeah, let's look closer because, like I said, there are other AI companies that are probably further along here. All right. So let me see here. Ivan. All right. Looks like you got a little Bored Apes NFT there. Do you actually own that NFT? That would be interesting here. So any thoughts on Apple tapping iPhones to buy things? Does that hurt Square Block? Oh, we did talk about this briefly. So Apple's pairing with Stripe to do this. And Stripe is already a company that's valued at roughly 100. Before this, it was valued at roughly 100 billion, somewhere between 90 and 100 billion dollars. They're planning to go public later on this year. I think they filed their documents like back in July, and then in November they said they were intending to go public in Q1 of 2022. I bet because of all the delays at the SEC that they don't go public until second quarter of 2022, and then the environment will be hopefully improved. I still expect this to be one of the largest IPOs in all of history. I've talked about Stripe before and how they have simplified connecting your website, your app, your device to the world of finance with a simple 7 lines of code. That's all it takes. I was a software developer way back in the day when it was a nightmare to get a company to get your website to process credit cards. It was an absolute nightmare. Now that's all changed. Stripe is kind of leading the way on that. It's this Irish American company that's out there. It's a great story too about these guys that developed it, and I think that it's a big danger for Square and Block. So I think it's a bigger danger for PayPal. Square looked like they saw this coming down the road already and started to pivot to other things. They've gone big into blockchain. So Jack Marone says, love the videos I'm seeing with Nvidia, but what about AMD or Intel? Can they compete? So no, they can definitely compete, and they're not necessarily making and designing chips in the same arena as well. I think that this is going to be a case of, right. So essentially, it's not simply the pandemic that has caused the shortage. It's not simply that the supply lines were shut down. We're using 20% more chips for all things than we were in 2019. And there simply hasn't been enough enough capacity built up to do that, right? And it's not just the type of chips that Nvidia designs. Nvidia is not going to be the only one in cloud computing. They're not going to be the only one in metaverse. They're not going to be the only one in this online gaming space or what is there? Theirs is called Omniverse or something like that. No, I definitely think that AMD and Intel are both going to do quite well, but they are just larger, more mature companies, and they are going to need to see a serious movement in fundamentals in order to get people as excited about them and investors excited about them as they are in Nvidia. So yeah, definitely, I think that AMD and Intel could do just as well, right? Crispy Tacos 84 says yes, since it was featured on the TV show Age of AI. I am interested in why they would feature that company and not a whole host of other companies. You would think they would have gone with so PACCAR's. They've been like a part supplier for a long time for the trucking industry, and they're a much older company, and they're much further along in terms of their technology. There's a couple of there's Dana International also that has an autonomous project going on where they've actually got cars on the road as well. They've been tagged to be the producers of Hyliion's vehicle. They're going to make a lot of parts for Hyliion's vehicle. Dana International is. And so, yeah, the trucking industry is something that I'm really supremely interested in just because not every country delivers the majority of their freight using trucks. The United States is really one of the only places that does that, right? That's certainly not the case in Europe. It's certainly not the case in Asia. They don't use these giant Class 8 trucks we have this unique issue here in the U.S. So, and I don't know if you guys heard this or not, but the company that I hate the most, Nikola, actually has delivered some test vehicles, hydrogen fuel cell vehicles in Europe that are actually being used at this point. So I'm very, very curious to see how that works out. Now that Trevor Milton is gone, I don't really want to see the company to fail. I want them to be legitimate. That technology is better than the technologies we're using now. I'd rather see us burn clean hydrogen where the waste product is water than fossil fuels. That would be great. I'd like to see us generate the power needed to crack hydrogen out of water as well to be clean energy as well. And that's the real challenge. Right now, most hydrogen is developed from natural gas, which makes it not a carbon-free process, right? It's by its very definition, it is a process that has a huge impact on the company's gonna have a huge carbon footprint unless everything they do is solar. So, so definitely concerning. I wanted to take the time to talk about a piece of important news. Let's see if I can share my screen again. Regarding Xpeng. And hold on, whoops, made a mistake there. Okay, so this is a big news, guys. If you're a citizen in China, like on the mainland, and you want to invest in Xpeng shares, it's actually kind of difficult to do, or at least it was up until today. Hong Kong's Xpeng shares. Let's bring up this article right here. And this is the reason for the big jump in Xpeng shares today, is that ordinary shares of Xpeng, which trade on the Stock Exchange of Hong Kong, have been included on the Shenzhen Hong Kong Stock Connect programs, which basically connects the Hong Kong exchange to the mainland Shenzhen exchange. Shenzhen exchange is just right across the water there in the Pearl River Delta, where 57 million Chinese people live. And this move enables qualified investors from the Chinese mainland to have direct access to Xpeng's Hong Kong shares, subject to specific daily quotas, so as to improve the liquidity of the startup stocks. What this basically means is there's a much wider group of investors now who are able to buy into Xpeng stock. So you can expect NIO and Li Auto to follow in short order. They tend to do things kind of lockstep in tandem when it comes to these like regulatory things. Like if Xpeng does a secondary offering, NIO is going to do one, Li is going to do one. If Xpeng now is part of this bridge program, then NIO is sure to follow. And we'll probably see a bump up in NIO price because of that. I still stand by, deliveries are not going to be good for February. and it has nothing to do with production capacity or a reduction in demand. It has everything to do with Chinese New Year. So deliveries will not be good for Xpeng, NIO, or Li, or even BYD in that time period, or even Tesla. They're going to suffer some. But yeah, so there we go. That's the big news. That is the cause of the spike in Xpeng shares. And that is something that I definitely wanted to talk about. So here's the same thing. Basically the last week of sales in January was kind of missing because people are traveling. Everyone who has money can afford to go home to visit their family. The construction of the Chinese labor market is very different than it is here. Most people work in cities that they're not from, and there's historical reasons behind that, which were very relevant to China years ago, not so much today. But it means that their working population is highly mobile around holidays. And last week in January, lots of people were taking time off to travel home. This week, or like last week up until now, most people were either traveling or intoxicated who could afford a NIO or an Xpeng. And celebrations don't end until the 15th, although last week is like the big celebration. So Nissan Motors started the year 2022 with a decline in total sales in China. However, its Venucia brand managed to over double its monthly sales and volume in the meantime. So they sold a total of 133,467 vehicles in a month. Won't it be nice when NIO and Xpeng are selling 133,000 vehicles in a month? And that's an 8.7% year-on-year decline. Automaker blames scattered COVID breakouts and the crimped raw material supply. Of course, that is definitely a concern. No one is prepared for the demand, the demand for vehicles. Like China is outselling the United States, or outbuying the United States 2-1 in terms of electric vehicles. I traveled a lot this summer to places outside of California and noticed that there are a lot fewer electric cars on the road outside of California. It's definitely, like it or not, if there's an automotive trend and it starts here in California, it's probably going to spread somewhere else. Electric vehicles are coming to your market. They are coming. Hold on just a second here. Let me see. All right. So any other questions that you guys have right now, feel free to ask those. Just as a reminder, the super chat features are on. Looking at the markets year to date, I know that as tech investors, folks have felt a lot of pain, but look at these trend lines here for all of the different market sectors. The only one that is up at this point is XLE, which is actually energy. Everything else is down at this point. And when I say it's down, let me be clear, things could be a lot worse. I've personally lived through a lot worse. Lots of people have lived through a lot worse. So that is definitely something you guys want to think about, is that markets are actually pretty flat for the year after the last week and a half, and they're not really all that far down. If you look at technology, let's see, I'm colorblind here, only down 7.51% overall. We're looking at, the NASDAQ 100 is down 7.88%. We're looking at energy here being up 23%, and that is really the only thing that's positive except for XLF. And what is XLF? Financials. So that's not surprising at all. Financials being up when there's a threat of interest rates rising is not surprising at all. Financials tend to do well over time with a little bit of lag when interest rates start to rise. It usually takes 2 or 3 quarters for all that to be reflected. So, let me hear. There's a username Baby Neo making a comment here. So they have a question. What do you think about MOTS? So let's take a look at MOTS here for a second. Modus GI Holding. This is not a company that I've looked at before. So we'll take a quick look at their financials. And so this is typically a company that I would not cover. It's a penny stock. The volume on it is under 1 million, meaning that not very many shares change hands per day. It's not all that healthy of a market. So they're showing a loss here. It's highly volatile, and the market cap is 21 million, right? So this is typically not a company that I would cover, but let's see what they do. Surprisingly, they have recommendations, all right? So it's a medical technology company that provides endoscopy solutions to enhance clinical outcomes and the cost efficiency associated with colonoscopy in the United States and Israel. Its flagship product is PureView, a medical device to facilitate cleaning of a poorly prepared colon during the colonoscopy procedure. Gross. But hey, necessary. All right. And as we all get older, we're going to be thinking about things like this. I really don't know enough about the technology itself to comment on that. So we can talk about the information that we do have. They have some really stellar recommendations here from some heavyweights, and it seems to be well covered. There's a lot of people, and mean recommendation is almost a strong buy here. It's 1.5. So, but in terms of earnings, they've got no revenues, right? Negative 13 million, negative 22 million, negative 23, narrowed losses a little bit, but they only had $98,000 in revenue. So they're burning cash right now. This is a cash burning machine. They've been in business at least for 4 years here, and they're still burning here. So as you guys can tell, from my advertisements here, I'm very interested in the lithium iron phosphate battery technology. And so that's why I keep showing up as advertisements. I'm putting together a solar system for my boat, and I'm going to use all lithium batteries to do that. So lithium iron phosphate batteries. Anyway, if anyone's paying attention to that kind of thing. So I think that this would be a highly speculative stock at this point. And if that's what you're looking for, maybe that's great. We're looking at it's pretty close to the bottom of its 52-week range at this point. Let's see how long it's been traded for. And it's been it's been public at least since 2018, February 12th, 2018. So not all that long. And it's been steadily declining. Like I said, though, I just don't know enough about the technology itself to comment on that. And I like to know about the technology and have a good idea about the technology before I make an investment. So, yeah, there we go. And let me see here. And how much do you respect TA pair of fundamentals or only for, I don't. So in terms of, you're talking about technical analysis, in terms of the long-term value of technical analysis. And look, I look at it like anyone else, but I know that all of the academic research that's available out there, and there've been massive studies, and not just one, but dozens of massive academic studies done on technical analysis, and it does not work over time. There is no indication that it works over time. And even the indications that it does work over short periods or in certain times, I think that's all affected by selection bias. And then there was some other research project that kind of determined that too, that you're really looking at periods where it works, but you're really kind of cherry picking the periods where it does work. If you look over at any random 10-year period, technical analysis is not going to help you out, and it's just going to hurt you. Fundamental analysis, even when it comes to value investing, it definitely shows that there's an increase in your return over time, but it wasn't really that great. I want to say it was only something like 60 basis points, which makes a difference over time. It really does. But in terms of what you're going to notice as a human trading on those things, because we don't really think in terms of like 10-year periods, you may not notice it, and it may lead you to behaviors that cause you to underperform the market. So most investors not only underperform the market, they underperform the investment that they actually own. And if you watched my video that I did kind of in defense of ARK Invest, the average dollar return for ARK Invest over that period where they average, like from 2014 to 2020, the company, all the funds averaged like a 30% annual return. But the average return to the investor in that time period was only 10%. And 30, it was ARK funds at 35. The average investor only got 10 because they tended to buy out long after buy in long after the majority of earnings had been made, and to bail out as soon as there were trouble. And it just basically cut off what they were making on the high end, and they ended up guaranteeing a loss on the low end. So it wasn't that they were buying low or buying high and selling low. It's just they were buying too late and selling too early in a lot of cases. So there's a lot to be said about just buying and holding. Do your fundamental analysis. Buy a stock. And I tell you, a lot of what I do goes into ETFs and I don't think about it ever again. I'm never taking it out of there, never thinking about it, never going to trade it, never going to sell it, never nothing. But even with my individual stocks, I rarely sell a stock. I may sell options on it, but I rarely sell. So, for example, I've been selling options on Tesla for close to a decade now and haven't sold any. And even if I have to unwind a trade and eat a loss, which I just did recently, like in September, I think I ended up losing like missing out on like $18,000 in gains or something because I ended up I got greedy when I was selling options and started selling them tighter and tighter and tighter. And I woke up and the stock went from $700 a share to like $930 overnight. And I had sold some calls at like 9:15, like 2 calls at 9:15. So I had to unwind 2 trades, pay $8,000 to get out of those trades because I didn't want to trigger a giant capital gain tax. So I'm happy to eat the loss to not have to pay capital gain tax on that. And then, of course, it's taken me like up till now to make most of that up. Or I mean, I still haven't made it all up from selling options again. But that's the thing. It's like I don't even really want to sell. If I'm selling a cover call, it's going to be pretty far out of the money. And I don't actually want to sell the stock. And I'll probably unwind the trade if it ends up being in the money and eating the loss rather than letting it sell and having to pay taxes. And then you have to wait longer than 30 days to get back into the stock to avoid the wash sale rule and not being able to use the loss or the tax gain or whatever you have in that. So I tend to sell options and not buy any. And I tend to roll my options once I have a significant gain in them, like, 50, 70, 80% gain in the options. So 80% of options expire unexercised, which is why I sell options rather than buy them. And once they really have a good gain in it, I roll it over to the next week and I try to get my delta. I usually want my delta significantly under 3. The higher the volatility of the stock is, of course, the higher the premium is. But you can even sell call options on something like Realty Income that trades under O. It's a really stable REIT. You can even sell options on that, and per 100 shares, you're going to generate like an extra $30 a month. But when you look at, it's only got a yield of 4%, an extra $30 a month on the $6,800 or $7,000 you paid for that investment. That's actually significant. It means that your income that you're deriving off of that investment is now somewhere around 7 or 8% over a year, rather than 4% yield just on the dividend, right? So it's really significant when you start doing it. And I'm doing that, selling those options. They're going to have a delta of maybe like 0.15 or something like that. And I've never had I've never even come close really to having my Realty Income shares called away. And that's how you can increase your yield up to like 8% a year on a stock. And you guys should be employing some of these strategies. It's very hard though for you. You can't go to a financial advisor and they're not going to give you advice on this strategy because they can't anymore. Every compliance department prevents their advisors from giving people individualized advice on individual options trading. Like your only source of information for this is really going to be reading books, blogs, and YouTube videos. And I can tell you a lot of the advice on YouTube videos is crap. It is not good at all. Really not good at all. So so I tend not to use technical analysis because my time horizon is so long for the stocks that I buy. It's theoretically forever. And because I realize that I'm not going to agonize over getting the lowest price today, here's what I'll do instead of worrying about grabbing the lowest price and trying to time my trade. I'll sell a cash secured put. If I have $11,000 and I want to buy 100 shares of Square, then I'm going to sell a cash secured put at like 105. So if at the end of next week or the week after that or week after that, it drops below 105, then I'll own that stock at 105. Now, if it drops to 80 or 90, I'll have a little bit of regret, of course. But for every week that expires, I'm getting paid $200, $300, $500 just to wait around and think about owning Square stock, right? I don't think that market conditions are going to improve greatly right away. I think we've got another couple of periods of volatility. I do think that the bull market has not ended though, and we are not going into recession. So Noir said, Chidaporn. I don't know how to pronounce your name. I'm sorry. Now that SoFi is officially a bank, shouldn't a rising interest rate be good news for their top and bottom lines? Absolutely. Absolutely. And that's one of the reasons why when I brought up Koifin here, today's markets, and the only other indication here that is positive, XLF, is actually financials. It's up 5% for the year. And I started talking about this last year. I'm like, well, if we go through a period of rising interest rates, financials are going to do really, really well. And financials have done well in most crises, except the ones that were financial specific, like 2008, 2009 was really specific to financials. But if you go back and look at the dot-com crash, if you own the the financials index from the S&P 500 was down 9, 11, 22% between 2001 or 2000, 2001, 2002, right? So it was down 9, 11, 22%. Financials were up every single year. And mutual funds that were heavy on financials, like the American funds portfolio, they actually had positive returns when we had 3 successive years of negative stock returns. Your American funds portfolio actually grew something like 20% over that time. And that was all because they were heavily weighted in financials. Now, that strategy, of course, backfired magnificently on them in 2008. But this is a time period where I would be comfortable owning some larger financials. I know that Cathie Wood is like, oh, the banks are going to be destroyed by this. And like, okay. And she understands, though, just as well as I do, that Goldman Sachs doesn't make money off banking operations. They make money off of investment banking operations, which is a very different story. Wells Fargo makes a lot of their money off of investment banking operations. And they make a lot of money off of trading too. And they make a lot of money off of a giant fixed income portfolio. So things that you may not be thinking about that are going to do really, really well in this time period that are financials, but you don't think about, is insurance companies. Property and casualty insurance companies, barring any giant hurricane events and tornado events that we have, those are going to do really, really well. So the best investors in the world are not even, the best investors in the world are not really financials. They are insurance companies. And let me talk about that for a second. So banks go out of business all the time. It wasn't just 2008, 2009 that banks fail all the time, but they're allowed to fail graciously, meaning that usually some other bank steps in, or some other consortium of banks steps in and buys their deposit base, and then of course their loan portfolio gets broken up and all that. So and you have things like FDIC insurance, which backstop banks, meaning that the first $250,000 per registration of money that you put into a bank is protected. Insurance companies don't have that sort of backstop. So they have a state insurance fund that will pay out on claims based on fraudulent activity, but they don't have the same degree of protection when it comes to just not doing business well. Banks fail all the time. Insurance companies almost never fail. AIG was a giant exception to that rule, and that's largely because their parent company, which was kind of their trading arm, that's what failed, and they had obligations they couldn't meet. But AIG and life insurance, AIG annuity, all these were sold off as completely healthy subsidiaries that were completely profitable. And part of it has to do with how the insurance industry is arranged. So the formula is not exactly this, but it's kind of like this. For every dollar in claims that an insurance company is responsible for, they have to have $3 invested to support that claim, right? So they have 3 times what they're responsible for invested, right? So and generally they have to keep a reserve that is equal to something like 5 Hurricane Katrinas could strike in 1 year, and the company is supposed to be able to survive financially. Now, we haven't had that happen, thankfully, so that's never been tested. But we've certainly had years where companies had a high degree of. So USAA is a company that had a high degree of property and casualty concentration in the South, and they have that because of they serve military members, and they have a vast amount of military members buy first, second, and third properties in the places where they are stationed. So it just so happens that the majority of the risk in their property and casualty portfolio, which focuses on the South, which gets hit by hurricanes. There's a couple of times they had a multi-hurricane year huge disaster, and they're still paying out their employees 10, 11, 12, 18% bonuses because the company's still profitable and they're able to absorb those losses. Every insurance company is like this. If you see insurance companies starting to drop off left and right, then you know the economy is really, really in trouble. Because of how they're regulated, it's very difficult for an insurance company to go out of business. So looking at companies like the Hartford might not be a bad idea. Looking at companies like I don't think New York Life is publicly traded, but publicly traded insurance companies like the Hartford would be a good one to look at. Maybe Jackson National is publicly traded. I don't know. I don't remember all the names of all the insurance companies anymore. But take a look out there at life insurance companies and property casualty insurance companies. Geico they're not publicly traded, but life insurance and companies and property and casualty insurance companies that are publicly traded may be a good safe haven for money if you're less worried about growth and you're more worried about inflation. That may be a good place to be at this point. So yeah. So not getting a ton of questions on the channel today, guys. I don't know if I'm just rambling on too much or you guys don't have much to talk about. I'm happy to talk about anything you guys want to talk about. Just let me know in the comments if you guys have a particular stock you want me to take a look at. Oh, in terms of my guest tomorrow, he will not be answering any questions about individual stocks. We're really going to be talking about macroeconomy, what we expect for the market going forward, what we expect about the Fed decision coming up here. I think that the employment figures from last week, which I was watching a news channel that for some reason, this one particular news channel I watched definitely wants the economy to be really bad. And that is one of the things that I think that is one of the things that I think that people really sorry guys, lost my train of thought completely because I saw a question. Do you beat the S&P, Jason? Okay, the answer to that is simple. Yes, and complex, because the answer to that is I take way more risk than the S&P 500 does. And that's probably the reason that I outperform the S&P is I'm taking a lot more in the way of risk. My portfolio is so volatile that I'll go up and down 14, 16% in a day sometimes. All right. The S&P and 500 is not doing that. And a lot of that has to do with the high concentration that I have in Tesla, which I've had for a decade. High concentration in tech stocks, which I've had for a decade. I'm happy to over time to outperform the S&P 500, but a lot of people would not be able to stomach what I can stomach. Part of the reason I can do that is because I keep a large cash reserve, and I'm not dependent on what comes out of my my stock accounts for money, and I will depend on that in retirement, of course, but I have other business interests that I will be able to sell before I retire, or some of them that'll keep going. But the reality is I can take more risk. It's not because the money doesn't matter. It's because I know that my time horizon is super long. And I know the psychological traps of I'm in a position that's down, that money is dead. It's not dead. It may take a year and a half for it to come back, but it's not dead. And if you sell out of that fund or stock and get into something else, you will not be better off. In fact, that is something a lot of research has gone in there too. So, so do I beat the S&P 500? Yes. There are plenty of investors that do, and they do this by taking more risk. When you look at a mutual fund that operates under the rules that a mutual fund is supposed to operate under, almost none of them are going to beat the S&P 500 in a single year. There's only like a 13% chance that they will, and less than 5% of them will over a 20 or 30-year period. Now, who was it? Dave Ramsey. Not a fan of Dave Ramsey. I'm not. And I know that's that's something that somebody unsubscribed right now just because I said I'm not a fan of Dave Ramsey. Some of the things he says on debt is very, very good. But I'm very cynical when I watch his show. And he did a presentation where he said that it's not true that mutual funds don't outperform the S&P 500. And then he named this like list of statistics. And in his statistics that he listed on there, what he didn't realize is that he was showing the reason why most funds don't outperform the S&P 500. He was ignoring survivorship bias. So he starts off on, of all these funds that started in 1970, and there were like 1,000 of them. And then he says, these many outperform the S&P 500, and these many. The problem was that number was whittled down from 1970 to 1,000 funds down to like 54. So 950 of those funds either failed, merged, or changed styles. So he's really looking at survivorship bias. Everyone else merged, failed, or didn't, or merged, failed, or changed so much that they couldn't be compared against the S&P 500 anymore. So most investment strategies, even with professionals, failed, and the S&P 500, even in terms of investment professionals, was probably not the best way to go. So even when it comes to looking at Cathie Wood, I actually think that she being the best performing mutual fund manager from 2014 to 2020 was a fluke. I think that was a fluke. I think that what comes next is going to prove that she might be one of the greatest investors on the planet. I think she was still early. I think that Tesla was the test case for their strategy for disruptive innovation. And now that we're going to see all of these other cases come to fruition, especially genomics, battery storage. She was just talking about electric vehicles. Now that narrative has changed from electric vehicles now to like energy storage, right? Energy storage technologies. We're looking at different ways to store energy, not just lithium ion batteries, but I think sodium ion batteries, gravity storage, vanadium flow, all kinds of other things are out there that are coming down the road. That is, and like I said, I think it's a fluke. She was early on everything except Tesla. I think that what comes next is likely to be pretty amazing. And I think that it doesn't necessarily benefit you to look at what she trades in and just buy what she has. There's a science behind when she's buying and when she's selling some certain things. So, yeah. Jack Monroe says, thank you for that explanation on insurance companies. That was so informative. My dad's in insurance, and he's had the best years in his past 3 years. Yeah. Insurance companies, like I said, they are the best investors on the planet. It is not investment bankers. BB Neo says, do you think Neo will hit 60 plus this year? I think that it might be a possibility. It's a possibility. It's an outside possibility, though. Just somebody else asked if Xpeng is going to hit 100 in the next year. I don't think so. And I don't think that Neo will hit 60 this year. I do think one thing is going to be clear, though, is that the Chinese economy is going to start accelerating and growing faster than the U.S. economy is this year. I think that they have fewer headwinds against them. There's a few incidences, of course, that could throw everything off. One of those is war between Russia and Ukraine. I think that Ukraine has no strategic value for the United States, but we will get involved in some way, and I think that's probably a mistake. That's as far as I'm going to get into politics on this live stream, but I think it's just going to be bad for business, and I don't want anything to be bad for business. I think that China's economy in shifts. They're on the rise. They're a young and dynamic society at this point. And I know people are saying they're not young. They have lots of old people. The wealth and economic power has really shifted to the wealth has shifted to a younger generation than it's ever been to before. And I was just reading an article on that, is that the older generation of Chinese folks is actually transferring wealth to their children far earlier than they have in the past. And they're using that to make new investments to fund entrepreneurial ventures. And I think that's very exciting for the Chinese economy. And I don't think I'd like to live in China myself, especially like looking the way I do. I don't think I'd want to live there, but I think that life is going to get much better. It's going to get much better for Chinese people here in the future. So, yeah. So, hi, Jason. What do you think about the news talking about SoftBank going to dump their Alibaba shares, even though SoftBank later says they will sell? So, SoftBank dumps shares all the time. They started off as a cell phone company, and they become sort of this business conglomeration, this business incubation conglomeration where they do early stage investment companies all the time, and they sell out when they think they've made some money. I'm surprised that they hadn't dumped Alibaba shares earlier when it was at a high, when they thought it was at a peak, in order to invest in something else that was newer and innovative. But I can tell you that they probably see the same things that we all do, is that government interference ostensibly is there to increase competition, but I think it's more about control. And I think that SoftBank is probably seeing the writing on the wall, that they don't want to be involved in a business that has caught the attention of CCP authorities. And I don't know that that's even possible for them to do. I don't know what you know about SoftBank, but they're this giant Japanese company that has investments in thousands of companies. Like, they own a slice of Sea Limited. They own a slice of a couple of different AI companies. They own slices of different EV manufacturers. They owned at one point, I think they owned a piece of Tencent as well. I don't know if they still do, but they buy and sell shares of everything all the time. They even were invested in SoFi. They may have dumped their SoFi stake, or at least the majority of it. I don't really remember. All right. But yeah, in terms of SoFi, though, I think that this is going to be SoFi's turnaround year. I think by the end of the year, we're probably going to see $25 to $30 range for SoFi. And from that point on, it's going to steadily grow. I think that we see profitability for them probably sometime in early 2024. I don't really want to see it before that. They have a lot of expanding they need to do, and a lot of investment in infrastructure that they need to do. What I want to see is solid 25 to 40% growth in revenues. And what I want to see, of course, is promotion of their technology platform, which is really what I see as their easiest way to profitability. So I'm actually pretty excited to listen to the SoFi call. Maybe I'll do like a live stream during the SoFi call. I don't know if I can do that or not. So maybe I'll try and do that, though. Anyway, folks, I am starting to get hungry again. I ate kind of early today, so I'm starting to get hungry. So I think I'm going to call this one a day. And also, the questions have kind of slowed down. If I missed someone, I apologize. Like I said, with the software that I'm using, not every question comes over. And if I miss your question, it was not intentional. I try and answer every single question that comes through. But thank you very much, guys. I always enjoy doing this. I'll be back on at 9:30 in the morning with a guest, and we're going to be talking about some more macroeconomic stuff. And I'm going to let him talk a lot about the research that his firm is involved in. So thank you so much, guys, and you have a nice evening.